In the fifth consolidation workings video accompanying the module devoted to Goodwill, we will be exploring a scenario which leads to the recognition of a gain on a bargain purchase. Accordingly, example 5 reads: P acquired the entire share capital of S for €7,500 on the 1st of January 2017, when the statements of a financial position of the two entities were as follows. Additionally, we are told that at the date of acquisition, the fair value of S's other assets exceeded their book value by €600. And our job is to prepare a consolidated statement of a financial position as at the 1st of January, the date of acquisition. The first working concerns group structure, and we will once again write that P owns 100% of S. The second working is subsidiary net assets, and as always we need the standard 3 columns: acquisition date, consolidation date, and post-acquisition. Now on the left-hand side we have 3 rows, the first for share capital, the second for retained earnings, and the third for fair value adjustments relating to S's other assets. So in the first column we will have 5,000 in respect of share capital, 3,000 for retained earnings, as well as an additional €600 to bring S's net assets total to their acquisition date fair value. Seeing as the consolidation is performed upon acquisition, the second column repeats the same numbers, with the post-acquisition column showing no movement. The third working, Goodwill, begins with the €7,500 investment by the parent entity, from which we need to deduct the €8,600 fair value of the subsidiary's net assets as at the date of acquisition, which we take from the acquisition date column of working 2. And for the first time in this series of worked examples, we find that Goodwill comes in at a negative €1,100. As you may recall from the first video of this module, a negative goodwill result is actually referred to as a gain on a bargain purchase and ought to be recognized in the consolidated income statement at the time of acquisition. Let us nevertheless stress that before any such gain is actually posted to P&L, the assessment of the fair values of the subsidiary's net assets must be reviewed for potential misstatements. Working number 4 is once again called non-controlling interest, but there is still no need to make use of it, which brings us to working 5, group retained earnings. This kicks off with the entire retained earnings of the parent, that's 12,000. Because we identified the presence of negative goodwill, we must also include an additional €1,100 gain as part of this working. And finally, as always, we add the parent's share of retained earnings generated by the subsidiary since acquisition. Recall that as part of working 2, we already identified this number to be 0, which leaves us with a group retained earnings total of €13,100. Let us now put all of the pieces together in the consolidated statement of financial position as at the 1st of January 2017. Seeing as the transaction did not generate any positive goodwill, we begin with other assets, which equal the sum of the two values coming from the books of P and S, but also include that €600 of fair value adjustment, which brings the total to €23,600. The equity section comprises €6,000 in respect of share capital, as well as group retained earnings of €13,100 as derived in working 5, which produces an overall consolidated equity balance of €19,100. Group liabilities are simply the sum of the relevant P&S numbers, giving €4,500, which brings the balance of consolidated equity and liabilities to €23,600.